we have our next conversation, as I put it, in terms of, the capital stack. We move on to then the asset managers. We celebrate India's climate scale story with our first plenary session, Investors at the Forefront. This session with the asset managers will go beyond celebrating past milestones and will chart the path ahead, how climate entrepreneurs and investors together can unlock scale, accelerate impact, and position India's innovations to inspire and serve other global markets. So on that note, I would request the panelists and the moderator to please join us on stage. Mr. Alipth Sharma, Partner, South Asia Advisors, Global Environment Fund; Ruchira Shukla, Managing Partner, Green Marble Ventures; Nakul Zaveri, Partner and Co-Head Climate Investment Strategy, Leapfrog Investments; Sandeep Bhamar, Founder and Managing Partner, Green Frontier Capital; and moderating this wonderful conversation for us is Royston Briganza, CEO, Grameen Impact Investments, and member, ISE Executive Council.
But it's fascinating to be here this morning. Good morning to everyone who's really coming on time. I think we should put our hands together for Anjana, who did a fabulous job of a panel and then on staying on time. It's always a bane when the first panel overruns, which then causes the rest of the day to get run behind schedule. But the topic for today is celebrating the Indian climate story, investors at the forefront. So this calls for celebration. Sandeep's coming in with the champagne, right, Sandeep? No. No bubbly. So we'll have to rely on the sparkling wit of everyone here since we have no sparkling wine. But Sandeep, thank you for making sure that Trump and Xi meeting finished well, and the closing comments seem to be that the world need not worry about the economic trends. It just finished a few minutes ago. But with that, let's just jump in. I think the panel is described as visionaries who have been at the forefront of climate investing in India. One such visionary to my right is Nakul. Nakul, you've really seen this sector evolve with many, many hats. And maybe if you could just rewind the clock a little and take us through your journey of why did you pick climate and how you've seen that evolve. And then from there, we can double click.
Thank you. Hello? Yeah. Thank you, Royston. First of all, I think I have to tell Sandeep, your photo wins the award of the best looking photo on the panel. I've had the fortune of seeing climate investing when it was called clean tech. And then when it moved into the carbon markets in the early 2000s. And then we saw climate change, renewable energy, climate tech, climate smart. And now what everyone calls, I don't know if you know this, but it's called systems thinking as well. So we've kind of gone through a whole host of frameworks. But what has been very, very clear is the question that I keep on asking myself is, what is climate investing? Climate is not a category. It is not a technology. It is a physical reality. And in that physical reality, societies are getting motivated to rethink the way we generate our energy, the way we grow and consume our food, the way we move around, and the way we build our cities. And in that case, essentially, if you overlay that with the emerging markets, or what we call global growth, the 50% of global GDP growth is going to come from our markets in the next 2 decades. And therefore, will this growth happen on the back of incumbent technology and energy sources, or does it happen behind what we call a green leap? So from a climate perspective, while it has taken a lot of names, it's essentially undergoing a value migration. So there are opportunities, there are risks that we need to address. Climate touches many, many sectors. It's not limited to one sector. It looks at many, many stacks. But it's all happening in a condensed time zone, which is a lot of early stage investments are happening. At the same time, we are seeing a lot of infrastructure investments. In any sector, usually you see this evolution happening over many decades. But in climate, we are seeing renewable energy investments happening, skyrocketing on one side, and then hard to abate sectors in a very early stage happening where there is no commercial viability, and then everything in between. At Leapfrog, we are essentially focused on impact investing across financial services, healthcare, and climate, but more focused towards the emerging consumer across the value chain, right? So we will try and not do hard-to-abate sectors, but we'll do everything that impacts how the consumer is consuming stuff.
So it's interesting, what you mentioned sort of really flows from what Gaurav was saying on the earlier panel. One of the things he mentioned was there's less money for smaller scale. And therefore he said, think scale, think big. To you, Ruchika, though, however, you've seen, in some sense, the bottom of the scale pyramid in your early hats. And do you think, really we've not fixed that issue and we are sort of jumping between wherever there's convenient LP capital, or we are looking really at a systemic solution for the system change that we need to have?
I think every market goes through its evolution process, and so is India. Like Nakul, I've had the journey of seeing the clean tech 1.0 during my days at IFC, where I spent 12 years trying to champion tech investments and building the tech portfolio. And I realize now, marrying what I saw there with what I'm doing today with my venture fund, that a lot of the early capital for climate has gone towards large-scale projects. And these could be, wind farms, solar projects, distributed solar, and more recently, some of the EV OEMs. But there is a big gap, because for making some of these projects continue to grow at scale, a simple thing as feeding renewable energy at scale to the grid, you need technologies. You need long duration battery storage. You need those BESS systems. And while India produces batteries, India doesn't produce battery cells. India imports the magnets, India imports, when you talk about industrial decarbonization, India imports all the motors. So a lot of the key products and components that are critical to making these infrastructure settings scale are still gotten from outside the country. And from a handful of nations, which makes the supply chain concentration risk very high. And a lot of the current trade tariff conversations become very relevant here, because if China were to cut out the supply of certain equipment, certain materials, a lot of large industries would be in significant trouble. And so the world is looking for India to step up and fill the gap. We need diversified supply chains for the world and for our own country. So I'm a champion for seeing the ecosystem evolve both at the large end as it continues to grow, but also at the early end where tech disruptions can make those large-scale projects viable.
Thank you so much. Alit, I'm just sort of picking up from where Ruchika talked about, the global context and the need for trade, supply chains. GEF has about $2 billion of funds deployed under deployment, and this is across America, Latin America, Asia. How do you see from a global lens, where are those sort of exciting areas of opportunity? What are the bottlenecks? What are the challenges?
Thanks, Roysman. So I think, as you rightly said, at GEF we manage capital across 3 geographies primarily. I think the underlying climate thematic focus, I would say, remains the same. However, the economic rationale of which sector is attractive varies from region to region. So at GEF what we believe in is that philosophically we are tied at the hip, but each region we raise pools of capital which are different, and we deploy it in a manner which is more conducive for what is economically attractive for us in each region. So I would say that, but kind of going back to first principles, when you look at, maybe to the point Nakul made, I think the way we see it, climate, is that it doesn't need to be defined as some subcategory of investment. If you look at what 2 countries need today, they need energy security, they need food security, they need water security. So without going into whether it's a climate deal or a non-climate deal, if you can solve for these 3 principal needs with economic models that support viability of businesses, you create attractive opportunities for capital across the spectrum. So it could be early stage, late stage, we are more growth stage investors. That's the way we kind of visualize the opportunity. So we believe that these three fundamental tenets of what each geography or country needs are common across the spectrum. And within then you have to find your pockets of opportunity. As Ruchira said, for example, in the Indian parlance, the opportunity is obviously to de-risk supply chains, right, for example. So can you create, there's an immense potential, for example, therefore in the EV value chain for early stage ventures, and then once they mature for late stage ventures. There's immense opportunity on the renewable energy side, maybe now that we have a base load of solar and wind in terms of integrating battery energy storage and making hybrid systems and smarter systems. So the opportunity set would vary, but the potential is immense.
Fabulous. And those are segments that, we're really investing in, whether it's storage, whether it's e-mobility. But one of the not new anymore, sectors that seems to be really galloping is, the AI space. And Sandeep, I'm looking at you because I just read a recent article which said that just energy requirements of the top 4 AI and the cloud storage companies is going to be more than 2.5 states of California put together. Now, that is staggering. At the same time, the race for AI is on. So how do you see it from your perch where you live, across the Gulf of Mexico, Gulf of America, whatever, take your pick. Where do you see that storage energy coming from?
Thank you, Royce. Thanks, ISC, for having me. So obviously, one of the advantages of staying in the States is it gives us an opportunity to identify trends that have emerged there that we can arbitrage at relatively reasonable valuations in India before they've emerged. And right now, obviously, AI is a very, very hot area. But we think that AI is its own, or should be looked upon as its own emerging emissions vertical. So while AI does a lot of great things, it helps create optimization in supply chain, it helps you effectively, do all kinds of interesting things. The fact of the matter is that if you just look at a single large language model and the amount of energy that a single large language model consumes, it's enough to power hundreds of homes each year. So there is an opportunity in AI, but the idea is to identify where those opportunities in AI are. And for us, if you can actually marry AI with climate in a manner that is efficient from an energy expendable energy point of view, there is an option to make a lot of money. So where do we find those areas? Liquid cooling chips, low data centers is another area where I think is another great opportunity. Another great opportunity is any kind of algorithmic innovation that can reduce emissions from the constant usage of large language models by more than 90%. So there are lots of great areas. Unlike a growth fund, early stage funds don't have the ability to see through the final result of the technology that you're investing in. We look upon ourselves as people who invest and subsidize innovation at a very early stage, create PMF so that the large guys can come in and write $25 million checks and scale them up. And one final point that I would like to add, which is in reference to what some of my colleague speakers have here said, is that in the past, India used to innovate for the rest of the world. Now, India is the fastest, largest growing economy in the world. So we should be looking for companies that are going to be consumers of global innovation rather than looking for companies that innovate in India and basically export it outwards. And therein lies the opportunity. So if there is a technology transfer potential in a company here that can use that technology to address climate change with jugaad, with a lower price point, those are the kind of businesses that become much more attractive. So hopefully that answers your question.
Thank you, and we'll stay with you, and then we may go in the reverse order for the next round. Since you mentioned early stage, since you mentioned Jugaad, since you mentioned Indian companies, maybe in this round you can talk a little bit about your own fund, you can talk about a little bit about your own thesis, and the type of entities that GFC would be interested in investing in, and what's your worldview?
Yeah, sure. So obviously, we do believe that climate is an existential crisis, even though Bill Gates keeps basically flip-flopping on whether it is or it's not. And those of you who have not seen the latest Instagram post that's come out by Bill Gates, he's actually now
You
questioning
couldn't resist that, right?
Yeah, yeah. But again, hopefully Bill Gates is not watching this, and when we reach out to him, he'll still give us money to manage for him in India. India, in terms of climate emissions, its known story, is the third largest emitter of climate emissions, but it's also the fastest, largest growing economy in the world. And therefore, if the world has to solve its climate emissions issues, it has to do it through India. That's a thesis that's common for all of us. But what we feel, how we take that thesis a little bit further is to say that we want to invest in companies that try and address the 3Ds. And what are the 3Ds? The 3Ds are digitization, address climate change through the 3Ds. Digitization, decarbonization, and disruption. So in India particularly, in order for you to make money, you need scale. Scale can only come through disruption. You need to make sure that those businesses are asset light so that you're able to also scale disruptive businesses rapidly, because we don't have the ability with our LPs to sit through a 10 and 15-year time process. And last of all, obviously, they have to have measurable decarbonization impact. So one of the things that our LPs ask us to do is to say, don't just tell us that you're addressing climate change through your companies, show us the numbers. And so what we do differently, and what we have done differently, is that we actually go to all of our companies, we actually single out impact metrics that are specific to their industries and ask them to report those metrics on a monthly basis to us. And then those make for very interesting discussions. And then we aggregate the sum total of those impact metrics and share it on our website, not just for our LPs, but for the world at large to consume. Because at the end of the day, we all agree climate is collaborative. It's not green marbles versus green frontier. It's green marbles with green frontier that can actually take climate as a subject and address it efficiently.
Awesome. Thank you so much. And I'll let, it's too many acronyms, GEF, GFC, but I'll try and remember them. But maybe the same question to you. From your perch, what's your thesis? What's the size? What's your worldview?
So as growth capital investors, I think the ecosystem is very important for us, because I think, having been in climate as GEF for the last 35 odd years, and in India with presence on the ground for the last 16, if you look back, I think what was lacking when we started out as growth investors was the ecosystem of early stage financing, because there's a lot of promise and potential in entrepreneurs, but they need financial support. There's no doing without that, right? So that ecosystem development is obviously key for us, and I think as Sandeep rightly said, it's a symbiotic relationship. I think not just within, say, early stage funds, but within early stage venture growth, the entire ecosystem has to work together. And I think, to your question, I think the opportunity is immense, but the ecosystem is not just limited to us as providers of equity capital. The ecosystem also means government support in terms of policy and infrastructure. It means lenders kind of understanding what climate finance is, what's the need of the sector. And you've seen that evolve. So for example, I would say probably the most mature thesis in the climate story in India is the renewable energy story. If you look at that, you have PPA frameworks in place. I don't think anyone questions government intent or the policy framework when it comes to renewable energy. Lenders understand the product, the tenors and the rate of lending has moved to what is amenable to support the kind of growth renewable energy needs. But again, the point is that renewable energy is a very small piece of that puzzle, right? There's electrifications, there's decarbonization, industrial decarbonization. Now, all of these are fairly complex solutions which will again need a similar kind of support framework. So again, very bullish on the opportunity, but I think there are pieces of the ecosystem which still need to evolve and reach a stage of maturity.
Ruchira?
No, I sort of will build on what's been said and tie it back to our strategy. Our strategy is very early stage, so it's early stage tech and engineering and science-based disruptions for climate. So it includes a lot of products that, and we don't go pre-revenue, we look for at least paid pilots, but we go in relatively early compared to my other co-panelists. And we're looking for solutions which can be relevant for a global market. So of course, India itself is a very big market, but as I was saying in my earlier remarks, there are supply chain concentrations on some of these products globally, and they could win, not just within India and beyond. I like to go with teams which are doing something fundamentally different, so it has to be highly disruptive, but at the same time, teams that are coachable. And a lot of the companies that come out of tech-focused ideas, the founders tend to have a deep tech background but lack the commercialization, the strategy, the organizational building skills. So one key part of our strategy as a fund is to lean in heavily and help build these institutions and organizations. So very actively work as a fund to help shape the journeys of the founders and the companies in the early stage. And therein I would build on what Sandeep said. I think the ecosystem is very important. In India today, despite the huge size of the market and the big agenda for climate, there are maybe under 20 or 30 individuals who are really passionate, seasoned investors who can help these early stage companies. So we need to do it collaboratively. We need to join rounds together. We need to mentor each other's startups. We need to sit on boards of each other's startups, because having seen that play out for IFC, where we had 20 direct investments, several of them are listed now, I saw that journey from that first check to listing is fairly challenging. There are several pivots. There are several people that require hand-holding during that process. So coming together as an ecosystem and helping co-build these companies together collaboratively is a big part of what we as a fund want to do, and I think what's needed today.
You made me a little nostalgic. I was thinking of the investment that IFC made in Bandhan,
Yes.
which is when they were an NBFC, and we as Grameen had helped Bandhan to transition from an NGO to to a for-profit to an NBFC, and then they got a bank license.
There would be at least most tech companies will have at least 4 or 5 pivots before you can say, yes, this is a successful IPO, this got successfully acquired. And we've seen that play out through the work that I was doing leading tech investing for IFC. Over 12 years, almost every company that succeeded had to have a change of direction multiple times. So I've come to understand and empathize with that. And that's okay. We need the right leadership, guidance, mentorship for that to happen. And no single fund GP will be able to do it alone, including for their own portfolio. We will need to collaborate.
No, that's
Royce, just one point on that, if you don't mind. I'll give you one example of a collaboration that has worked in the climate space, Leapfrog and Green Frontier Capital. We invested in a company called Battery Smart when it was just a concept. And it was a small investment. And when Leapfrog actually finally came in and invested, it had become the single largest interoperability battery swapping network. And with that, just to share with you how growth capital investors can catalyze capital, apart from the money that they put into Battery Smart, we also exited, thereby creating returns for our investors who now don't see climate as an impact-only led area, but a place to actually make money. And with that Battery Smart exit, we were able to catalyze more capital to then further invest in companies that we like, which will then further scale them for the Leapfrog to again continue the cycle. So that's how it continues. That loop happens when, and with a $25 to $50 million check, a growth capital investor is able to influence or at least discuss policy with the government, which a investor putting $2 to $3 million in a company may not be able to, and therefore realize that vision for those companies and make them actual businesses. So just give you an example.
That's great. You know what, as Ruchira said, there are about 20 people that are really motivated about this space. We are fortunate that IFC has found 4 of them, put them on this panel. So that's already exciting to hear. And you know, Sandeep referred to you, Nakul, in terms of, you know, Leapfrog providing that exit, strategic exit, exciting the LPs of the early stage funds because of, you know, being able to see that path to scale, seeing that journey. The word leapfrog itself, you know, is interesting because it helps to leapfrog and move paces, move levels. How has, you know, a leapfrog done that, and what's your worldview?
Thank you, Royston. There are KPIs on the panelists to use the word leapfrog, so I think we're doing well. But I think, you know, just stepping back, the ethos of founding Leapfrog was to make sure that how do we drive what we call profit with purpose, right? Is that a real case? We are not too old in that ecosystem. We are actually 18 years in existence, so we are now technically an adult in most parts of the world. But the ethos was that, listen, we can look at commercially viable opportunities which can scale, because if they don't scale, it goes into the realm of philanthropy, right? So that is important. And then we believe that the low-hanging fruits or the high impact creating sectors or essential services for moving low-income consumers into prosperity are access to financial services, access to food, access to energy, and access to urban systems, going back to my earlier thesis, right? And therefore, financial services, healthcare, and climate solutions were the 3 sectors we looked at. And particularly what excites us on the climate side is, remember, emerging markets will evolve business models differently than sometimes the West. And it's happening on the climate side. It's happening sometimes because of energy security that we need it's happening because, as Sandeep mentioned, India is growing and we need companies building for India. It's also happening because emerging markets are different. To give you an example, the West electrified top down, right? The Teslas came first. The emerging markets are electrifying bottom up. So you're starting with 2-wheelers and 3-wheelers. But we also have a density problem. I don't think the West understands that parking doesn't almost exist in emerging markets, whether it's a large city or a small city, whereas parking is not an issue. And therefore, innovative models like swapping comes in, innovative models like as a service comes through. I mean, even today, the Zeptos of the world, which have created last mile hyperlocal place, don't exist in many parts of the world. Those new business models will require a very different solution coming through. And that's where some of these early stage pipeline building play, growth stage where Alip and I kind of come in, it becomes important. But at the end of the day, any opportunity that needs scale requires the right kind of regulatory direction. It requires the right kind of financial ecosystem to be built in. It cannot disrupt habits culturally. For example, you cannot ask them to do something differently that you've been doing for many years, but pay a premium. And the last point I want to drive at is, if you are asking for a green premium, then you will not be able to scale any business models. But what has been exciting is that green premium is transitioning into a green discount. Affordability becomes very, very critical for emerging consumers, and that's a key metric for us to invest.
Excellent. I think we've had some really exciting perspectives. And one of the points that, again, my mind goes back to, and there are two approaches from the way I see it from the Grameen lens. The whole approach seems to be the ability to be able to really reach the underserved, to be able to bring solutions to the bottom of the pyramid. But the other lens that I see it is with the view on microfinance. In some ways, it's an ecosystem success story where you had the initial startups, you had the pools of capital, you had an enabling policy, which was the 2% CSR of the government, but more importantly, the 40% priority sector lending of the RBI. which then required priority sector lending impetus, agriculture, weaker sections, and all of that. Many equity investors played a fabulous role in getting microfinance to where it is. But every one of them, either in public or at least in heart of heart, will agree that it would not have been able to do it if it wasn't for debt that built the scale. So the ability for the equity investors to get that upside, for the early stage equity investors to hand off to growth stage investors, for the mainstream pools, for the listings and the IPOs, all of that happened because debt came in. And yet, we're sitting on an opening panel with visionaries, but have, 4 out of the 5 of us who are looking at equity. Is there a flaw in the design? Are we missing something on the debt side? Nakul, we'll start with you and go back in the order.
Royston, I think it's important. Again, going back to Ali's point on renewable energy, it wouldn't have scaled up if there was no project finance. So that is critical. And emerging markets understand some type of debts very well. So project finance is deeply understood. But early stage financing is still evolving, right? And especially on the debt side, we've got some institutions evolving. We are also seeing DFIs and MDBs, and including Niti Aayog, trying to build a platform which can spearhead those kind of debt in areas where climate finance becomes critical. And we're also seeing blended finance slowly evolving. So there is a lot of momentum going on. At the end of the day, if it does not make commercial sense, nothing can save it, whether it is debt capital or equity capital, right? And therefore, we need to make sure that some of the enabling ecosystem evolves much faster. There is a high amount of risk that early stage investors take. So there is a lot of ecosystem building on that side as well.
Super. Last week, Ruchira, the World Bank and IFC had their meetings. I'm drawing from your IFC hat again. Ajay talked about moving $8 billion to $30 billion of guarantee capacity. The point that Nakul made was on blended finance, commercial returns. One way to do that is to be able to catalyze pools of capital, de-risk capital, and really create the right risk-return portfolio. How do you see this ability of creating, whether it's MEGA or any other pools of guarantee capacity, blended finance, really helping equity investors? We're not saying it is, because it's equally important for you to be able to attract those debt pools for your portfolio companies, but also for a sector. What's really your view on that?
So I think the big gap there, as Nakul was saying, there's no gap. There's always gap in a market like India for everything, but project finance and large infrastructure debt has been solved by and large. The country understands it. There are lots of providers. They can take on that risk profile. I think where we are seeing a big gap is debt as a catalyst for equity, and you're absolutely right, that's needed in the early to early growth stages, right? So the first check in a product company has to be equity. There is no servicing capacity. They can't service debt at that point. But as the company scales, and a lot of the climate solutions, particularly around products that are tech disruptive, they tend to scale quickly because they have a tech moat, and they tend to reach EBITDA break even sooner than what other sectors like e-commerce or edutech and the like have seen in the past. And because they reach EBITDA break even quickly, they become candidates for debt. But the debt product for that early stage company is not available, right? Because a lot of banks and large financial institutions want to do still what is quasi name lending. Like, you need to have an established name, you need to be large enough, and they don't have the models to assess the credit risk profile of a younger early stage business. Plus, you need smaller ticket debt. And that smaller ticket debt is not available because their minimum deployment quantum is much larger than what the smaller startups could take. And therefore, I think there needs to be product or instrument disruption where you need to have smaller ticket debt, whether it's 2 million, 1 million sort of ticket sizes. Working capital lines available. A lot of these product companies need working capital financing because they need to build the equipment before they can sell the equipment. And so the invoicing and cash in comes in almost 6 months after the cash out of the company. So a lot of such debt products for early stage is definitely needed, and that can sort of turbocharge that space and help these companies scale.
Fabulous. One of the things, Alip, that was said on the earlier panel by Prasad is that there is no dearth of capital. I'm just trying to look at it with the lens of adaptation versus mitigation. Would you want to sort of provide more color to that? Is that a sentence we should just accept on face? And I'm not sort of reading into what he meant by that, but maybe you could, through your experience, give us a sense of capital for adaptation versus mitigation and resilience.
See, I think the case for mitigation is fairly simple. As in these are, you're directly kind of reducing carbon intensity, and I think the economic models are more defined when it comes to climate mitigation, and therefore, both for us as equity investors, and I'm assuming for lenders and everyone else also, supporting mitigation is far easier. I think adaptation is trickier because it's more transition, it's short term, and the economic models in adaptation are not as well defined. So if I look at just our own experience investing in India, for example, we have a company that does hybrid climate resilience seeds. Now that's a business that has traction, has scale, has potential, has grown, and is, we were able to take it from early check to now filing our document with SEBI for an IPO, right? So is there potential to scale adaptation businesses? Yes, but I think the problem lies in marrying the right economic model with an adaptation theme, and therefore if I would hazard a guess, we haven't analyzed it, but if you look at the universe of what all the funds, whether it's early stage, late stage, have done in the Indian context, you'll find that maybe 80 to 90% of the deals would qualify as mitigation and not really adaptation. And I think there may be, I don't have an answer. I don't think it's a policy thing. Policy frameworks can help, and you can maybe have carbon financing and stuff like that. Once it becomes more mature, that can help adaptation in some ways. But I think we will have to go deep into sectors. So it's like, for example, water is a theme. We've just done a third water transaction. However, although we believe there's huge potential in municipal level water solutions as well, we don't think it's economically attractive for us today as it exists. So our focus has been largely on industrial B2B solutions, and we're missing out a large opportunity, but today we are comfortable missing out on it because we don't believe the economic model exists. So
awesome. No, that's super useful. We have about 8 minutes left. I want to keep 5 for Q&A from the group. So I want to talk to you, Sandeep, about the perch that you see globally. We are on the verge of COP30 in Belém. We're seeing very interesting takes there around biodiversity, funding some of the new pools of capital. We're almost halfway, if not more, towards Agenda 2030. So this 30 seems to be haunting us. We're nowhere near any of the 30 milestones. 30 months from now, Sandeep, what do you see as the new pools of capital emerging? We won't talk about he who shall not be named, but we shall talk about, whether it's Mark Carney in Canada, whether it's Albanese in Australia, our friends from Japan. There are new pools of capital, Scandinavians, which have not been tapped. We go traditionally to the European investors, whom we know as European or the US investors. I see the current challenge as an opportunity to find new pools. What's your view?
So I think my view is that in India, there are pools of capital emerging which have historically not been tapped. Family offices are becoming big providers of capital and are actually acting as quasi-VC funds themselves. The government itself has set up new pools of capital, although not specifically directed at climate, directed at areas such as deep tech, hard tech, which you can then marry with a climate opportunity and present it as a deep tech opportunity and then access that pool of capital. Also, given the sheer size of India and the kind of savings rates we have, the public market access has become a huge opportunity for a lot of funds to come up with new offerings that are aimed at specific thematic areas. As you're aware, I was a 15-year public markets guy, and yet, in spite of having gone a step
You look
earlier,
30. Since we are on
Thank
the
you.
30 theme.
okay, I'll take that as a compliment for sure. But the fact of the matter is that I've been doing climate now for over 5 years, and I still don't see public market opportunities that are directed at the climate space. Not too many climate thematic funds that are out there. And so India actually has presented a real wide variety of opportunities to tap capital from. One just has to be smart. I did want to also mention on the issue of debt, since you asked the panel, but I was not able to answer. In the early stage sector, debt providers are nothing but quasi-equity investors, because there is nothing to collateralize with a tech company that's focusing on climate. It's just a smart way of structuring your investment to get higher liquidation preference rights and to not set valuations if you're unsure of the business, because you're investing very early on in a business. You invest in a convertible, provide that capital, let the company create its business profile, and then let a smart growth capital investor to come in who has the benefit of 5 years of history to set valuations for that business. And because you provided capital early and you hold a convertible instrument, you then basically convert that instrument at a huge discount to where that new investor is coming in.
Awesome.
So that's where I feel debt capital, and there was a constant reference to debt as a catalyst for equity. But in fact, if you look at the way in which the capital stack ought to be structured, equity is always the catalyst for debt. You won't get debt capital until first somebody provides equity.
Sure.
So what we must do is still focus on the early stage equity piece. It will then at some point in time catalyze debt, which will then in turn basically catalyze larger
Fabulous,
equity.
fabulous, fabulous. So our efficient panel has saved 4 minutes for questions. We can take 2 questions, and if there are. Otherwise, you'll hear me summarize. So at your own risk. We have one hand there. That's there. Just continue speaking, they will pick it up and
Yeah, thanks a lot. I'm Deepa Joshi from the International Water Management Institute. 3 very quick questions. Is the science on green technologies robust? You know, whether you look at electric vehicles to hydropower, I think there's a lot of evidence that what was considered green is not essentially green. So how do you work into bringing science into, so that the outcomes are longer term sustainable climate outcomes? Second is that all of this investment that's happening, you know, how much of it is built around principles of ethical investing? So what is the spillover and the impact on social inclusion
Can
and
we just
gender
take
equality?
those 2 if you don't mind? Is
Okay,
yeah.
thank you.
I can maybe answer actually both of them in a combined way. So I think my sense is all of us are fairly responsible investors here on the panel. So science-based targets are a fundamental part of, as Sandeep was mentioning, they measure, they report. We do the same. So I think the climate investing movement is moving towards what is away from what was maybe called greenwashing to deterministic outcomes on what your investments actually create in terms of impact, which is measurable in terms of scientific parameters, and there are SBTi norms and a lot of I would say ecosystem development globally that's happening in terms of quantifying what your climate impact is from your investments. And similarly on the societal impact, right? So when we do our, I think DNSH as a framework is very important for us, which is do no significant harm. So you know, when we are looking at investing in a company, we're just not looking at the climate adaptation mitigation benefit. We're also looking at what the ancillary negative consequences, if any, can be from the investment.
Thanks. Nakul, we'll just go in order so that we can wrap it up. We have 30 seconds each.
No, I think Alipta has mentioned this very clearly. Most of our investors are very obsessed with making sure that intent, authenticity, and standards are followed. Going back to Sandeep's point on measurement, there are rigorous measurement standards applied, they're audited, we need to stand behind them. I think most green technologies now are net emission negative. Whether you talk about electrification, specifically in emerging markets, because the intensity of, for example, tailpipe emission, when you talk about mobility in cities, is so high that the net argument here becomes again negative. So there are models that are being evolved, there are frameworks that are being evolved, and to give you an example, there are 1,400 frameworks, 600 standards, 300 regulations already in place, right? And we have to now, unfortunately, spend more money to try and adhere to most of them.
And there are 90 seconds left. So I'm going to ask the two of them to take 30 seconds each. Any closing comment or answering one of those two?
No, I'll just make a quick comment that actually addresses your point as well. Remember, we are custodians of someone else's capital, right? And we will only be in business if we can meet all those points you brought up and deliver strong financial returns. And they are related, because we can't if we back an investment that is not backed by science or doesn't have an inclusive model, it's not going to give returns. So the long-term game only plays out if both impact and financial returns coexist.
Thank you. Sandeep, 30 seconds.
Also, the one additional point there is that the downside of reporting incorrectly would also mean that the sustainability of your own business becomes questionable. So not only are there regulatory requirements and LP requirements for reporting, but you're also held to a very high standard where if you don't correctly report and transparently report, the repercussions for that as a going concern then become a big question mark.
Awesome, awesome. I want to just say I've picked up one word from each of you. From Nakul, this whole holistic approach that is needed, that we all work together to be able to really scale climate and green investment. From you, Alip, different opportunities, whether they are adaptation, mitigation, resilience, different ways to look at it. From you, Ruchira, products, the different products that are needed, the innovation that's needed. And from you, Sandeep, evidence. Show us the numbers. And if you spell those out, those read HOPE, which is fabulous. That's a great way to end. Thank you, everyone.
Fantastic.
Let's give a
Thank
panel
you.
a big hand.
Thank you to all our panelists and our moderator, Royston, for such a dynamic and thoughtful discussion.